Good afternoon, ladies and gentlemen, and welcome to the Team Internet Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it is appropriate to do so. Before we begin, as usual, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the executive management team from Team Internet Group PLC. Michael, good afternoon, sir.
Thank you, Jake, and welcome everyone to the Team Internet Group Q3 2024 results presentation. And I'm here with Billy Green, who will present the second chapter of this presentation after I have run you through the business profile and will ultimately take control back for the strategy and outlook session. So for those who are new to the case, we always start the slide with this overview, what we do. So Team Internet Group is active is a leading global internet solutions company operating in two highly attractive segments: digital audience matching, which in our reporting is called the online marketing segment, and digital identity solution, which in our reporting we call the online presence segment. In online marketing, we match audiences across so-called walled gardens. Walled gardens are the big internet companies like Meta, ByteDance, Google, Amazon, and others who basically try to keep the users within their own ecosystem most of the time. And we use artificial intelligence and first-party data, so data that we have on the internet users, to basically build bridges between these walled gardens, make the kids surfing on TikTok click on an advertising that someone has booked on Google. And in this business, we have generated $471 million of revenue in the first 9 months of this year, which is almost 1% down compared to last year. However, at the same time, we were able to extract more margin from this. So the net revenue, so basically what we get from Google, Amazon, and others, less what we paid to Meta, ByteDance, and others, increased to $95.4 million. That's $10.6 million every month in the first 9 months this year. And this we have managed by increasing the number of visitors that engage with our conversion processes from 5.6 billion to 6.5 billion, and will continue to grow this number. And in the following, we are going to present to you a few slides that show how we will overcome these trends and ride on a wave of success. In online presence, in contrast, we empower businesses and individuals worldwide to create, maintain, and protect their digital identities worldwide. And digital identity typically starts with a domain name. So this is where we have a global subscriber base, both through direct and indirect channels. And in this business, our revenue has grown to $144 million in the first 9 months. And also the margin has expanded notably from $44 million to $48 million. And that is also, the growth is also due to further increases in pricing. First, because we are enforcing more fair pricing for the great value that we deliver for our customer, but we're also focusing on more exotic products, which are closer to our core purpose and yield higher margins. On the following 3 slides, we are going to present to you how we will take the business forward. And the background is, of course, that the numbers that you will have seen this morning were not necessarily what you were expecting. And so we understand that most of you will have the question on top of the head, what is this company going to do to ultimately send the company back into the growth mode that we were used to over the last couple of years? And on these next three slides, which we present for the first time publicly today, we explain how we transform our three largest businesses into the future. So our largest business is our so-called search business, where I explained before, we bring people from TikTok and Instagram and bring them to our websites, where they then click on ads that other people have booked at Google. So what's the problem that we solve here? The problem that we solve is we bridge the Web 1.0, the companies that have been born on the early internet, when it was still dominated by media companies who created all the content, and bring them all the users that are now using the so-called Web 2.0, which is more about individual creators and user-generated content, with Meta being the biggest of these companies. Why does this business exist? Consumers, in particular younger, shift away from traditional search engines and the open web in general and trend towards social media and user-generated content. And we've already seen trillions of screen hours having drifted out of the open web into Facebook, Instagram, TikTok, X, you name it. Which means that if you're an advertiser on a search engine, you will buy a systematically overaged audience, because fewer younger people use search engines, classical search engines, less frequently than older generations would do. And we basically bridge this gap by bringing these parties together. This is how we've grown most of the $471 million of revenue in the first 9 months this year. What is now the opportunity? You may know from prior investor presentations how this workflow looks, where basically the user then ends up on a domain name, where you see some graphical orientation elements and then an ad in the center of the screen. This works perfectly for a clientele that we refer to as performance advertisers, people who want to sell a certain stuff. And however, next to that is another market of so-called brand advertisers, who are not necessarily looking at selling something very quickly, but who more are more interested in building the brand. And these people don't typically opt into our workflow, and we want to change this in order to expand our total addressable market. To do this, we need to harness generative AI, which can elevate the roughly 300,000 micro websites that we've told you about frequently into proper websites with proper content, maybe even videos in there, something that looks much more like a typical news or special interest website. And in close cooperation with our partner Google, we are implementing a new advertising format called related search on content that is specifically designed to not appear on the rather low content websites that we use now, but on content rich websites. What is the advantage? Brand advertisers typically have bigger budgets. A Louis Vuitton will always outcompete an insurance broker, for example. And with this content environment, also more sources let us send traffic there. So, for example, we would also now be able to send traffic from so-called display networks. 20 years ago, they were called manners on these websites. Or we might even send traffic from in-app sources, where the user would click in the app on an ad that we place there, and then be sent to one of our websites. Again, this will this will both rise the average click price and enlarge the total addressable market. What do we need to do to get there is to fix the user engagement. Now, in our current workflow, there's not many options. You can either click on back, close the browser, or click on the ad. Now with the content, you also have the opportunity to just get stuck with the content and not do anything. So here we now need to further develop this product and make sure that we do all the optimization. And we've spoken about this, that we want to be data driven. So our mottos are data, science, and compliance. So by using these three tools, we will now meticulously simulate any kind of configuration of these websites. What is the right font size? What is the right contrast between the font color and the background color? Where exactly go the ads? What kinds of ads resonate with what kind of language? Until we get this product to the same performance level like our old product, and once we are there, we expect a decade of massive continued growth, just in the style that we experienced it when we first discovered this principle that you could send social media traffic to so-called parked domain names to generate profits. And the big question is, of course, what is our license? What is our license to win? Why will not others eat this lunch? And the answer is, in the current prevailing workflow, we are the uncontested number one, which means we have more data on how consumers behave than anyone else, and we can also dedicate more traffic into testing the new format than anyone else. And through the acquisition, and we have a unique content and video publishing expertise, which comes through the acquisition of Shines, which we announced in early March. And you may have noted from the report this morning that the standalone performance of Shines is quite far from our expectations, which is very regretful. In this context, however, the data and the process that they have to create captivating content that keeps users not the typical 1 minute on a website, which is the standard for a news website, but rather keeps them there for 3, 4, or 5 minutes or even longer. That is super valuable in this process, because if users don't click on the Google ad, they will just start scrolling, and then we need to exactly apply the technology that Shines has developed in order to generate incremental revenue that should then ultimately help us to also become the world market leader in this brand advertiser targeted product related search on content. Coming to the next slide, comparison. And we noted in our report this morning that the comparison business, which we built from the acquisition of VGL Publishing AG in 2022, has been doing very, very well, so well that we will need to include it as a separate reporting segment in our upcoming annual report, which is of course good news, which means it has grown from where it was to now be a nearly twice as profitable business than it was at that time. And here the big transformation opportunity is to transform a national champion into a global consumer guide authority. So what is the problem that the comparison business solves? It is to remove noise and bias on the internet. Online consumers are exposed to extreme noise, biased messaging, and inconsistent data. Everyone claims to be the best. For some keywords, you have 1 or 2 pages of ads on Google. This is not very helpful for user. And we provide data-driven consumer guides that cut through this noise by using trusted, independent, and data-driven product recommendations. What is now the opportunity? The opportunity is to use generative AI to grow this business along 3 vectors. First is to go abroad. It is now much easier to create a performing website in in a foreign language once you have one that works in another language. So in the past, we've internationalized, since we announced to internationalize at the pace of one country per year. Now going forward, we are more looking into something like one country per month. So we've just done Italy in October. This month there will be Spain, and in the next year, in a relatively short order, we will then take most English-speaking countries. So we also bring the joy of using our portal not only to the UK but also to the Canada and the United States. The second vector is going long tail. So today, every product review costs a certain amount of money to have it written by a journalist with the right level of quality. While we still keep people in the process because we need to stand behind the quality of our product, now one journalist using AI can produce many more reviews in the same time. So the marginal cost for a new product review comes down dramatically, which means we will be able to afford way more reviews that will still make enough money to recover the content creation cost. So now we're thinking in hundreds, thousands of product reviews. In the future, we will think in millions of product reviews on our website properties. And the last step, even though that is more aspirational at this stage, is to also turn us into a direct-to-consumer brand and start selling products directly to customers, not only being an affiliate who drives traffic to other e-commerce companies, but at least for the product categories and the geographies where we have a high and relevant market share, we might actually try to sell the products directly to the consumer, which would then bring margins with it when you compare it to typical dropshipping businesses like a Wayfair in the United States, who operate roughly at 4 times the commission rate that we make in the business currently. So again, another massive chance for margin expansion. And of course, all of this opportunity doesn't come without its challenges. So in every country that we go, we will meet incumbents that have already conquered the market, which we then need to outcompete by achieving higher KPIs on conversion, just make more money per user so that we can actually buy up the best ad placements. We will need to manage computing power for the long tail expansion, and of course also becoming a direct to consumer business means more product, more customer service cost, which we will also need to offset by using more AI driven support. But what's our license to win here? So we can do all this at a very fast pace because over the last 2 years we've transformed the business from being an SEO first business to an SEA first business. What does that mean? SEO means to optimize your website in a way that Google puts it into the organic search results on the website. This is of course very interesting because then you get the traffic for free. But this becomes more and more difficult, and we will not have enough time today, but there's good reason to believe that SEO traffic will dramatically drop over the next few years. And anticipating this, we have experimented with our website so long until we found ways that we can now actually put paid ads on Google, which is much more controllable, and still make money from the process, which many companies can't do. The interesting thing is, for paid ads, there are no penalties for using AI content. So basically, just this innovation or this anticipation that SEO will be so difficult now allows us to use generative AI at a very large scale. And this is why we believe that with our current setup, we will outpace any other competitor in all the 3 growth vectors: going abroad, going long tail, and going direct to consumer. Coming to our most traditional business, the online division. So here, the job is to transform a domain name business into a digital identity business. So the problem that we solve today is making all domains accessible to everyone. Domain names are the cornerstone of online navigation. And in an increasingly globalized economy, we discovered the problem that also a Canadian must be able to own a Vietnamese domain name, which was not originally foreseen in the concept of domain names. And we overcame this hurdle, and this has grown us to a business that now handles more than 1,500 different domain extensions in around 300 countries, serving it to more than 4 million direct and indirect customers. What opportunity to build on this? The domain name is not just a string. The domain name is your digital identity. This is where your website is. This is from where you send an email, and your email again you use to log into all kinds of services. And controlling the access to domain names also enables you to promote all other kinds of digital of tokens of digital identity. So you start a new company. This is normally when you take a domain name. You might then take an LEI certificate that proves that you are really the company that you claim you are. You could order trademark docketing services to file a trademark in the name that matches your domain name. You could order having social media handles created for your business. So the business today doesn't stop at domain names. And however, very much to our surprise, there are no really established dominant players who would handle these other areas. So we actually seek to be a first mover here and have a platform where you can not only register the domain name that you need to start your online journey, but also all the other identity tokens that you need to prove that you are who you are. The challenge here is that these other ecosystems are just as fragmented as domain names, where every country has its own rules. Same here. Every country has different trademark rules. Every country has a different structure of company houses, trade registers, or similar. But that's ultimately great. This is our license to win because we have more than 25 years experience in managing such ecosystems with high compliance standards. And so we believe that we are very well poised to conquer this opportunity because we are trained at managing a fragmented ecosystem, and we're also lucky to have the most important digital distribution channels for domain names as our partners. So all GoDaddy, Register.com, Web.com, Squarespace, WordPress, etc. They would all use us to procure domain names that they need for their customers, and they've also, and a few of them have already expressed interest that they might also buy such alternative products from us if we were to offer them on a fully automated level. So where does this take us as the big picture? We're currently at the stage we've worked over the last couple of years to diminish our dependency on pairing social media users with search engine ads, and we already see some progress here. So the income from search engine ads is now below 60%, 57% in the 12 months that have been reviewed here. And the social media part is still 52%, but so here we have a certain balance. And here we've explained how we expect to grow this by developing a parallel content-rich customer acquisition process that then runs in parallel to the well-proven low-content channel that we currently operate. And but you already see that we've got plenty of other suppliers from whom we source different services or users, and many other channels that we expand. And of course, the strategies that we showed on the last two pages should help us growing the domain business, which you see on the bottom, notably by adding more products. Now you see on the left-hand side, there's only 1% value-added services going in there. That number should become dramatically higher than it is today. And on the page before, when discussing our comparison business, that sliver of revenue coming from e-commerce should also dramatically increase. And probably already when we show this slide at our year-end result updated for the full year, that number would probably already be notably higher than the 6% that we show here. This is in a nutshell what we do and how we intend to overcome the current challenges and deliver again the growth rates that you as our investor base were used to over the last couple of years. I'll now hand over to Billy for a detailed discussion of the results released this morning.
Thank you, Michael. Just taking you to the first page of the financials, the financial highlights for the 9 months ended 30th September 2024. You'll see in the top left-hand corner, we delivered gross revenue growth year on year for the 9-month period, growing by 1%. But that converts to a much higher percentage. Net revenue growth, net revenue being our term for gross profit, that grew by more like 4% year on year. So that's indicative that gross margin percentages improved year on year. So our higher margin products are currently growing at a faster pace than our lower margin products. And those of you who followed Team Internet for several years will remember that in the years in which the group's overall growth was highest, so in 2021, 2022 into 2023, we generally experienced the lower margin products growing at a faster rate than the higher margin products. So we're seeing somewhat the opposite of that in the current year, where we actually get a benefit, a boost at a net revenue or gross profit level from the fact that the higher margin products, such as the comparison business, as Michael referred to earlier, is growing faster than our search business, for example. So you end up with 4% net revenue growth. Then moving across one box to adjusted EBITDA, you'll see that adjusted EBITDA growth year on year for the 9 months was 2%. So the fact that that 2% growth rate is slightly lower than the 4% net revenue growth, that is something that we'd already noted going into Q3, that we need to be careful as a business that the operating cost base of the business grows at a slower pace than revenue growth, because naturally you would hope that you can manage your operating expenses to ensure that they should always grow at a slower rate than your revenue growth. So having seen over the last couple of quarters that our consistent improvement in EBITDA conversion is at risk of becoming more flat, and we want to keep improving our EBITDA conversion, we've actually taken some cost actions recently to look at the operating expense base of the business and to rebase that back down to a level whereby we can be confident prospectively that EBITDA conversion should continue to improve and operating expense growth should be fairly moderate, as you'd expect in any well-controlled business. So the operating expense base and the excess of revenue growth over EBITDA growth is something that we're focused on ensuring we're able to convert the same proportion of revenue growth into EBITDA growth as well as a minimum. The top right-hand corner, you'll see there that operating profit is down 1% year on year. And for those of you who may be wondering, well, okay, how does a 2% growth in adjusted EBITDA translate into a 1% decline in operating profit? The most material difference, as we'll see when we come on the next slide onto the more detailed income statement slide, the most material metric within that is that we have a higher amortization charge year on year. So amortization sits outside adjusted EBITDA. So the fact that the amortization charge, which is a non-cash charge, that being higher year on year, that does lead to the operating profit being, you'll see there are 200,000 lower year on year. And that is something that if we were to have presented, for example, the GAAP IFRS EBITDA, you would see that GAAP IFRS EBITDA is actually a couple of percent higher in terms of growth than adjusted EBITDA. So it is a question of what profit metrics one chooses to highlight. We don't choose the profit metrics that just happen to suit us in a particular quarter. We consistently present adjusted EBITDA and operating profit so that people can see the adjusted EBITDA being the true underlying trend of the business. Operating profit being the GAAP IFRS metric after all types of operating costs, including depreciation and amortization, so some non-cash charges there. But we're confident that delivering levels of operating profit of 30 million, and you'll see in the box in the bottom row, delivering profit after tax. So that's profit after interest, tax, all kinds of costs. Bottom line profitability delivery is still 11.9 million for the first 9 months of the year. So delivering near $12 million of bottom line profits in what's been quite a challenging year in some respects, before we even get to our fourth quarter, which is seasonally the largest quarter both for our search and comparison businesses. That still indicates that Team Internet remains a profitable business, and indeed a cash flow generative business, as we will touch on in a minute. The bottom left hand corner, you'll see adjusted EPS. Within EPS tends to should always outstrip for us the growth in earnings, because not only do you have you have positive earnings, but also the lower share count as a result of our continuing share buyback program. That should always lead to EPS being able to grow at a faster rate than earnings themselves. So 7% growth there it indicates that we're still fairly objectively adding to the value per share of what Team Internet represents as a business. And pretty much the only square we haven't dealt with on this slide, you'll see that net debt of 99.7 million is 35% higher than the level at year end, but that's actually down from where it was at the 30th of June. So following the acquisition of Shines, which we paid for in Q2, net debt naturally increased from the end of last year through to 30th of June. But in a quarter where we don't have any material M&A activity and we don't have a significant volume of share buybacks, which are funded through operating cash generation, we can instead use that operating cash generated to pay down some of our debt. So net debt is about $10 million lower at 30th September than it was at the 30th of June. Just looking at the income statement in a little bit more detail, as promised, a lot of this page has already been touched on, but you'll see there the increase in amortization of intangible assets, and you'll see the individual interest costs and income tax expense. Just one point to expand on around the net finance costs, i.e. the basically interest expense. You'll see on the right hand side of the page we've made a comment that net finance costs are decreasing during 2024. For the full 9-month period, finance costs are higher because we have more debt now than we did this time last year. But the reason why we're flagging that finance costs are decreasing is because gradually over the course of the year, the level of finance costs is lower in Q3 than it was in Q2. So it's not as if it's a perpetual increase in net debt and a perpetual increase in finance costs. In a quarter such as Q3, where we are successful in slightly decreasing our net debt, we benefit from a slightly lower similar interest rate, but against the lower debt base. And therefore, gradually over the course of the year, and as we move into Q4, we should see that net finance cost continue to be at a very manageable level. It's not as if the net finance costs are increasing significantly year on year. We still are well within the covenants and bounds of our borrowing agreements. We still have a material amount which could be borrowed on our RCF revolving credit facility if we needed to, but in practice, because the company is cash generative, literally in a quarter like Q3 where there's no limited non-recurring expenditure, the company generates cash and then uses that cash to pay down net debt. We are still rather a cash generation machine. You'll see that being a little clearer as we move on to the balance sheet as well. I've made a couple of comments about net debt and the fact that although gross debt is higher, and indeed net debt is higher than at the end of last year, it's actually 10.2 million lower than where it was at 30th of June. And if you look at the cash conversion of the business, the cash conversion is currently sitting at 91% for the 9 months year to date. And that is actually higher than it was in the last couple of quarters. So We say that we expect it to continue to normalise to nearer 100%. This exact same slide for Q1 reflected cash generation from operations of 80%, and then it was up to 87% for the 6 months, and now it's 91% for the 9 months. So if you were to look at each quarter in isolation, you'll see that each quarter is successively closer to 100% than Q1 was. So we're gradually inching towards being hopefully at least 95% plus by the end of the year. The aim, the target for every year with myself and the team throughout the business, we try to get to at least 100% conversion of operating profit to operating cash. We sit as of the end of September at 91% for the year to date, which is not as close to the target as myself and the team would like. So the closer we get to 100% as we move through to the end of the year, even if we don't quite hit 100%, it's not a binary metric on which we should judge ourselves. We just need to get as close to 100% as possible, and then go again next year with a 100% target again, so that we're ensuring that as much as possible of that $70 million of EBITDA is able to be converted into cash that we can then use either in M&A activity or to buy back shares or to pay down debt, i.e. in the interest of our shareholders. So you'll see that the cash conversion is getting towards a level as the year progresses, which is more objectively satisfying than the Q1 position, indicating that the cash performance of the business is getting back onto a track where we feel that we're doing everything that we can do, and we have a very steady, regular cash inflow and cash conversion from all parts of the business. There are typically very few, or it's very rare to see any kind of interruption in any part of the business. All three of the components of the business that Michael talked through earlier, search, comparison, and online presence, i.e. the domains business, they all continue to contribute towards getting as close as possible to that 100% target. And with that, I will pass over to Michael for an overview on the company's strategy and the outlook.
Thank you, Billy. So, and this slide is a good old friend, and despite the outcomes reported this morning, we still believe that the strategy is correct, which is trying to create a virtuous circle out of organic growth, operating leverage, competitive cost of capital, and focused bolt-on M&A. However, the balance of these three factors will now need to again focus on organic growth. We presented to you on 3 slides how we intend to create organic growth. Topic operating leverage. We've already taken during Q3 action to reduce the cost base, which will only become effective in Q4 and in Q1. We have over the last few years worked hard to get our EBITDA conversion ratio, so we define it as EBITDA divided by our gross profit, from the high 30s to now the low 50s, and we have full intention to keep it on that level where it currently is. And on the competitive cost of capital, we also need to do more work. So we had in summer made some progress on share price, which is now all, but we will now need to show other ways for shareholder for value discovery for shareholders, and the board will not leave any stone unturned in to find ways to unlock value in the given situation, and focus bolt-on M&A, whereas believe in the long-term value of it. Don't expect any acquisition anytime soon. So what are objectives? How do we want to change the company? So we want a more diversified set of revenue streams and supply sources. We've already spoken about the lower dependency on Google than before. We also want to become a more vertically integrated business, keeping more of the value that we create in specific markets ourselves. And we will also live up to our aspiration to be global leader in all the segments in which we operate. So in that search business, we're already there, and For comparison, we are now a national champion, but with a proper strategy to also take us to the global market. And in the domain business, we are already the number 2 globally, but however, with our faster growth than our peers, we should also make it to the number 1 position at the right time. In this endeavor, AI will help us. So we've basically got our AI strategy has 3 pillars. Raising the floor, democratizing AI, making sure that every employee has access to contemporary AI productivity tools to accomplish their task quicker than they could in the past. Then raising the ceiling, training our engineers and data scientists in state-of-the-art technology so that they can build products that not only meet but exceed customer expectations. And we also don't stop with our senior leadership and also send them to trainings for creative thinking and similar techniques, so that they would always be on the watch whether any new technology trend offers potential for disrupting some other company's business and integrate their value chain into ours. We end with the outlook statement. The outlook for the years 24 and 25 is owed to the current situation. Still very strong results, and we believe that the market is probably assigning a relatively high, if not dramatic, conglomerate discount to the business. We have a highly profitable online presence business with a market leading and forward-looking strategy, which could either be a public company in its own right or would find a new home in another group. We have a great comparison business that when we look at its EBITDA potential could also be a public company in its own right, or would be of interest to many other leading media groups across the world. And all of this is not reflected in the business, and the board will now do everything that it has to do in order to minimize, close that value gap. The good thing is that given the high cash reserve that we have, the strong operating cash generation, and our committed credit facilities, until we find that solution, we can still continue to invest in the future of our business and return cash to shareholders as we've done over the last 2 years. We still have an ongoing share buyback program running, and this is why, despite the difficult news to convey today, we're still bullish about the long-term prospects of the business, and in particular in the ability to unlock value by having a more structural review of the group. With that, we end the presentation and now move on to Q&A.
Perfect. Michael, Billy, if I may just jump back in there, and thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments just to review those questions that were submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboard. Michael, Billy, as you can see there, we have received a number of questions throughout your presentation this afternoon, and thank you to all of those on the call for taking the time to submit their questions. But guys, at this point, if I may just hand back to you just to make your way through the Q&A tab, just to read out those questions and give your responses where it's appropriate to do so. And if I pick up from you at the end, that'd be great. Thank you.
Thank you, Jake.
Sure. Shall I take the first one we can see on screen about
Please.
Meeting market expectations? So the question that we have here is, at the interims in August and in subsequent share buyback RNSs through to September, we stated that the company, we were confident the company would meet market expectations, and basically what's changed since then. And yeah, when it comes to the last earnings event in the middle of August, we were confident then that the company would meet market expectations. It was a question then of the to date slight underperformance of Shines being a drag on the company's numbers compared to the consensus, but that there was enough going on in the rest of the business that would get the company back up to market expectations. What's become apparent in the ensuing 3 months is that what looked like a slight drag is a bigger drag, and indeed the rest of the business hasn't generated enough growth to mop up that underperformance in the short term in Shines. So it's important that before the year gets any further, that we are completely transparent today about the various different moving parts in the business, the Shines and general search underperformance compared to expectations versus the product comparison and online presence domains business overperformance. The net result is the change to the outlook that we've made public today. So the expectations then were that we'd meet what the market expected. Now we are changing that statement as a result of the last 3 months. But we're hoping that now that we've revised that expectation, the company should now be on a good course to deliver what we believe will still be it's going to be again a super profitable year, somewhere between $95 and $100 million of EBITDA, which compared to the levels that the company was producing even a couple of years ago is materially higher. It's just a revised growth outlook that we are, now that we've shared it, obviously expect to talk about that over the coming months as we get back to hopefully a higher growth rate at some point in the near future.
Thanks, Billy. So then on the valuation gap between peers in both the online marketing and presence business. So in the meantime, there's not so many companies left anymore and at all kinds of valuation levels. But we also believe that there might be an additional conglomerate discount where, given that you have two businesses which are both great businesses to be in individually, but that address different investment styles. And again, the board is working on it to fix this, and we hope that we will come back to you with results during the year of 2025. So we really now need to address this problem, given that we of course can't let the share price be where it is.
We've then got a question about how the Shines acquisition proceeded, given the experience that the management team have within the group of due diligence and successful acquisitions, and I think that's a very fair point to raise. That if you look at the management team and the team that have delivered the Shines acquisition, it's primarily the same group of individuals who also delivered the Team Internet AG acquisition in 2019, the acquisition of the legacy Codewise businesses in Poland in 2020, and the VGL acquisition in 2022. So if you look at the track record of the group over the years, we do have a track record of very successful delivery of thoroughly diligenced acquisitions. Shines was again a thoroughly diligenced acquisition, but ultimately not every acquisition is going to integrate seamlessly into the group and hit the ground running in the same time frame at the same pace. So we have seen other acquisitions that we've made before go through an initial period of lower revenues and then recover strongly as we rebuild the business. So we do have a track record of ensuring that even if we buy something and it turns out there are operational or commercial needs within the business, we actually have very good integration processes, and we're confident the same will be the case with Shines. So there's nothing kind of different about Shines in terms of approach or diligence. It's a very valuable asset to the group if we treat it with the right due care and attention. It's just that we have more work to do there than we did with some of our other businesses. but we've always been able to make these businesses a success before, and we will do the same with Shines.
Right. And to the question, when do we anticipate a positive contribution from the Shines acquisition? We already anticipate that next year, in particular towards the second half of the year. And the change will largely be a change of the business model, going more from paid for traffic to more organic traffic. So think of it more going in the direction of an LBG Media or BuzzFeed to some part, and on the other hand, also focusing on short form video, which will then make it ultimately a more valuable business probably than it was. And in the meantime, the technology that we acquired will then help the transition process or the transformation process of our search division, so that we transform quicker than our competitors and secure firmly our number one position in that search referral market. And then on the question whether the strategy has been in response to the Q3 results, no, the strategy has been in making for a very long time. However, we now pulled these slides out maybe a quarter earlier than we would have normally done, because of course commercial sensitivity is always a trade-off when we need to explain investors what we do. I guess also today some of our competitors will listen in, and but this is why we've chosen to pull them out just at this point in time. But we also don't see a big problem with it. The technology that we've developed, we've put at least 12 months of development work in each of these strategies. So just someone listening in can't simply run away with the idea.
The next question is partially, but not wholly repetitive of the question about the Shines acquisition. You have conducted various successful acquisitions over many years. What are the main issues as you see them with the Shines acquisition in terms of the process of purchasing this company, and also from a current operational and commercial standpoint, I'd say? And how do you intend to improve those aspects and any additional learnings? And yes, the more successful acquisitions over the course of the last several years, certainly since I've been with the group in 2019 and Michael's been with the group since 2018, we've overseen many more quickly, more objectively successful acquisitions. We naturally do look at the M&A process within the business, and it's if there is anything within the Shines process that we see as something we can do better in future. Naturally, we'd look at that as we do with all of our control processes. There are with any deal there is a risk profile with any deal, and here the risk profile had some risks which were partly to do with timing, partly to do with the position of the target within the industry. It's still an industry, or rather a subsector of the industry, where we're very confident that we can help Shines to win, but that is something we obviously need to prove, and we obviously need to take the learnings from that acquisition through to future M&A activity. And then the following question is, I think, on the same topic again. And then there's a slightly different topic. With changes to the budget to inheritance tax relief, does the company still believe that the AIM market is the right market for the company to be on? And I'll be a bit careful what I say here, because there are probably many people on the call who are more directly involved with or have I suppose a stronger opinion on the inheritance tax relief related to AIM shares. I think most of the people that I speak to regularly, and my own perspective is that compared to the changes that people might have been fearing with the inheritance tax regime, for the government to introduce effectively what's half the tax that one would pay on transfers of value in respect of other assets, other investments, AIM still remains attractive to investors. I mean, a zero relief going away and now a 20% rate being introduced is obviously higher than it was before. But I, for one, am delighted that the government chose to retain that differentiation and that competitive advantage that AIM has. Obviously, it's not my place to say, and over time, whether we see a change to how AIM is perceived now that there is not a complete relief and only a partial relief on inheritance tax. But I saw it as a pretty mild outcome compared to some of the speculation prior to. So for us, AIM is still a thriving market to be on. But there is obviously over the coming years, we obviously all have to see how we see the market develop. But it is the right market or the right index for us to be on. The next question is to do with the debt levels. Market concern sometimes focuses on Team Internet's level of what's called here high debt. The buybacks and dividend have made no substantive difference to the share price. And what's the balance in the company between buybacks and aggressively paying down debt? We still don't believe it's appropriate to pay down to focus or to prioritize paying down debt. It's a hugely subjective area, of course, and we fully appreciate that there will be some individuals and institutions within our shareholder base who would prefer pay downs of debts, and then there will be some who would prefer us to return cash to shareholders by way of share buybacks. So we freely admit we're never going to. You can't keep everybody happy all the time. By having a balance between share buyback activity and debt has decreased during Q3, which is a fact that I hope doesn't escape the market's attention. 10.2 million lower at 30th September than it was at 30th of June. So even if we don't objectively see buyback activity leading to substantial appreciation in the share price, it's still important to us that we listen to a balance of all the different views across the market, because there is a balance to be had between how we use our cash. And indeed, the buyback activity has generally been well received. So the buyback scheme that we launched in September continues to make progress. It is moving at a relatively modest pace. The amounts of shares we're buying back each day is very easily manageable within the cash flow that we're generating. So one should see that net debt will be either the same or lower at the end of the year than it is now, and that hopefully will over time help to remind the market that in a quarter when we don't have any non-recurring M&A activity and only share buyback activity, we generate enough cash to ensure that we can still make a difference to our net debt and at least keep it at the same level, and without needing to stop the share buyback activity that benefits so many shareholders. Just looking at the next question.
Yeah. So here at this, I thought I'd already spoke about it, but maybe I didn't. It was another investor call. So we had anticipated that we would see a broad recovery of click prices during 2024, and many other market participants have put out similar messages in the first quarter of this year. However, by now, most have stopped that narrative. So the online advertising industry is still very difficult, with of course a few lucky exceptions. And but we now hope that under the new presidency of Donald Trump, we will finally see a very business-friendly politics in the United States, and hopefully some recovery of the advertising market to follow in 2025, so that our 24 projections could finally hold true in 2025.
Right, just trying to make sure that we focus on the questions that are on topics we haven't already addressed. Yep. So one question is, are you able to provide any more color around the options being considered to realize value for shareholders? And that's a fair question, because we've alluded to in our release today and in some of the narrative around the results, that there are multiple options for realizing the value within our asset portfolio. We have to be very, very careful that we reiterate that all parts of the business, I can't think of a single part of the business we've acquired during my time with the group or prior that it either isn't profitable or isn't core to the business. There are obviously some parts of the business that move quicker than others, and internally we are laser focused on our EBITDA conversion, and the parts of the business where their EBITDA conversion is lower than some of the others, they might sometimes feel unloved, but it's important that we put together plans, as indeed we are doing, for how we normalize everything to hopefully a consistently high achieving level of EBITDA conversion. So there's nothing specific that we're looking at in terms of the asset base and options being considered, but it is important that in the best interest of the shareholders, we look across the portfolio at least from time to time and see where where there might be options to realize value. So it is something that we're open to.
But we've of course followed with interest the split bit of the carve out of Optima Health by Barlow. Whether this will be the option that we choose or something else is of course way too early to judge at this stage.
Yeah. Within the remainder of the questions, I can't see anything that we haven't already addressed. I don't know about you, Michael, if there's anything that you see there that we haven't already talked through.
Yeah. So maybe just a general comment. So of course we are very frustrated about the situation at Shines, and our objective is to make money with acquisitions, like our Team Internet acquisition back in 2019. Now returns a purchase price almost every year after tax. Also, VGL now delivers twice the profit, even though they also had some difficult times in the trajectory. The important thing is to never give up, to assess what has gone wrong, and then fix it. I've already mentioned that we see a strategy to move it closer to a business like BuzzFeed. There was also quite a question on BuzzFeed is written with double Z, BUZZ, FEED, US public company, $100 million market cap. So that will be a bit the role model that we will try to replicate with this business. Other than that, of course, we use all typical tools. If when revenue is not in line with expectations, also the cost may not be in line with expectations, and we've already taken action in September and October, which will mostly be visible to some degree in Q4 and mostly in Q1, letting us start the new year with a different cost base than during the summer. And for the more specific disclosures, what went wrong? So every SPA has certain protection clauses in there, which we're currently exploring with our lawyers. So in order not to jeopardize the case, we cannot disclose much more detail on what exactly happened here. But we have a very clear forward how to build an even greater business from what we acquired. Good. We are 5 minutes behind time. I think even though there's still some question on screen, I think we have these were mostly duplicates. And well, thank you very much for taking the time today to hear our story, how we want to build back the trust that you've given in us. We understand that this is the first miss on numbers in a very long time, and but our job is now to pull all levers to finally get the EBITDA north of the $100 million and also review whether Team Internet Group in the structure that it has today is the smartest composition of these assets, or whether there's any change is required. But these, of course, things that you can only do once, and so we will take the board together with Billy and I will take some time to explore these options, assess them, and then when we think to have identified a superior option, then inform the market on what exactly we are going to do.
Michael, Billy, if I may just jump back in there, and thank you very much indeed for being so generous with your time and addressing all of those questions that came in from investors this afternoon. And thank you also once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Team Internet Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.